Hi everyone, this is Rob Roy of LA Wave Options and welcome to TradeFinder Live. Wow, okay, so it's been an interesting week since the last time we talked. Lots of stuff has happened, hasn't it? We were dealing with the election and everything else, and now we had the news from Pfizer on the potential vaccine. Market seemed to really like that, at least for a while. We'll talk about that in a minute. For those of you that are new, welcome to, if this is your first TradeFinder, just to give you a brief rundown of how this works. First of all, we have to share this wonderful disclaimer with you. And please, if it is your first time, take a screenshot of it, read it in detail in your leisure. I will highlight a couple things. Number one, we are not registered to give individual investment advice in the United States. And because we have a lot of international viewers and subscribers, any pricing that we're talking about is assumed to be in US dollars unless denoted otherwise. So those are two things the powers that be want us to make sure we emphasize. But again, take your time, read through it when you can. So how the TradeFinder works is we do this every Tuesday night, spend a few minutes talking about the market. We'll share with the latest patterns, things that have occurred in the market since the last week. After that, go through and show any case study alerts that we may have closed for our subscribers, give you a brief rundown of our service for subscribers, what they receive, use that as an educational tool for you as well. Then we'll go through any recent case study considerations over the past couple of weeks. If you've been following them, our record just continues to be pretty darn impressive, especially with what's going on in the past 2 weeks in the market. And then we'll look for some current case study considerations, see if we can find something tonight. And with whatever's time's left, we'll take questions at the end. So that's the general format. And let's go ahead and get into it. We've got lots to talk about, especially when we're dealing with the market. So here we are with the big move to the upside, and I want to walk us back just before the big move to the upside that occurred yesterday. So here's where we were at the close Friday. So let's even walk back a little bit further than that. Let's go back to Thursday of last week. You can see we had made a pretty good move to the upside, and I had shared with you that on the last S&P update, hopefully you watched that video recording where this upward zigzag pattern was still qualified. Nothing has changed that. We did have this potential zigzag. It was qualified as a zigzag at one time, but once we went up and reached past 70%, then we knew that it was going to be forming a flat, which is our newest educational a series that we post on our website. Tons of great education on our website. You don't have to be a subscriber if you want to take advantage of our education either. You can go to our website, ewotrader.com, and take a look at the education. It's there for you if you'd like to purchase it. It's free for our subscribers, but it's available for anyone that wants to learn more about Elliott Wave. So that was the completion of the flat. We moved to the upside. Now at this point in time, so here we are at Thursday of last week, and we have this separation here from the 10-day moving average. A lot of people were wondering how in the world is the market going up, especially with the chaos of the election. But if you had watched the S&P video that I did on how markets handle elections, going back historically, the markets are okay regardless. And I know we're all passionate about our political affiliation, so I don't get into that with our webinars and videos. We don't talk individual politics that way. The stuff I share is how markets handle political decisions, etc., but not playing favorites as far as parties. And the history shows the markets perform best when one party is not in full power. So if President Biden wins the presidency, which it looks like, and the Republicans hold the Senate, which it looks like, neither of those is official or final yet, but that appears where we're going to go. That's a good scenario for the market. The market will be okay during that. But I think that some of this move to the downside here may have been a little prep work of people that were worried about that blue sweep. That was everywhere. All of the media outlets were predicting that's what's going to happen. And just like they were 4 years ago, they were completely wrong again this time. It didn't occur. It didn't materialize. That the market wouldn't have liked. And again, I'm not playing politics saying that it's bad if Democrats control everything. I'm saying the market doesn't like it when one party controls everything, because then some extreme measures one way or the other can get passed. So the fact that we likely are going to have gridlock, if you will, that's when the markets are happiest. So at this point in time, we're a little bit overbought. So then we go into Friday, we got a weekend, we had a little bit of a consolidation. That Thursday night, I had done the recording on why is the market going to the upside. It's the market needs to rest. The market needs to calm down because we're a little bit overbought and going sideways and getting ready to try to take out this B wave high and the previous wave 5 high. We need a little bit of time. We need to let the 10-day moving average catch up. We need to maybe go sideways a bit, even a little bit of a pullback in the market. Either of those scenarios would have been fine, just to allow the energy to gather again to make a run at breaking what is pretty decent resistance from those two highs I just illustrated. Well, then we get the news of Pfizer's vaccine, which they say is 90% effective, which I hope they're right. In the realm of vaccines, that's really high of a percentage of being helpful. And normal vaccines don't even boast that kind of a record. So if that's true and real, then that's a great thing. The market loved it, but look where we opened. And boy, we were taking off alerts as fast as it could on Monday morning because of that big bounce. And so here we are. Now we're way overbought at this point in time. When the market opened, you can see the incredible separation we had from where the market was and the 10-day moving average. That's large for the S&P. Some individual stocks that are volatile and saying, okay, yeah, I see that from time to time. That's not that massive. But for the SPY, that's a big separation. So it made sense that the market wasn't going to hold that. So basically what we did was we took off the SPY calls and added SPY puts at the same time, because of the fact that this just was unlikely that we were going to hold that. And then we've got this big gap here that will get filled at some point in time, maybe not in the next couple of weeks, maybe in the next couple of weeks, but at some point it will. But we were just so overbought, it made sense to do that. And so now today we had a bit of a rest day, came back down from those highs, filled the gap. So it got filled within a day, and we're still a little separated from the 10-day moving average. Tomorrow, the bond market is closed because of Veterans Day. Equities markets are open, but the bond market's closed. And usually when the bond market is closed and the equity markets don't have that to take a direction from, things are kind of quiet. That would be ideal. So if the equity markets are just quiet tomorrow, let that 10-day moving average catch up. That's a great scenario for the markets themselves. But the thing that you should watch if you're bullish, or the most important thing of this whole scenario, is that we were not able to close at a new high. So we traded at a new high, we broke it. So all the media outlets are going to say the market's made a new high, but we didn't close there. And that doesn't really mean anything until we close back above there. And the fact that we didn't close above there is due to the fact that we were too overbought. It just wasn't enough momentum or energy left to hold that big move. So the wave 5 target moved. It's still only at an 85% corrective, or excuse me, 85% extension level. So we can come all the way up. The wave 5 and this C wave would be pretty close together as far as where their percentage targets are. That would make an awful lot of sense. But basically, we kind of have to reload now, if you will, because the market took one shot and wasn't able to close at new highs. So let's just calmed down a little bit. It's been a pretty vertical move from that C wave pivot at the end of the flat down here at on the 30th of October, 326. So we made a awfully large move in a very short period of time. And if you've listened to any of the recordings that I've done in the past, you know I don't like the vertical moves. Vertical moves tend to yield more volatile corrections. And maybe we come down more from here, back down towards that 10-day moving average. Maybe we test the 38.2% corrective level or extension level. We'll have to wait and see. But we're already down quite a bit from where the market opened just yesterday. So awful lot going on just since the last time that we met here last week. And so that's in general terms where things are. Interest rates are moving up, and that's not necessarily a good thing for sectors other than financials. Financials love that, but I don't think the Federal Reserve is too excited about that, especially when there's a lot of people questioning how many tools in their tool belt or bullets in their arsenal, whatever you want, whatever cliche you want to use, how much they have left. They say they still have plenty of things that they can do, but they don't want to see interest rates going up too significantly and hurt the economic recovery, especially with now we don't know, are we going to get shut down again in January? Is that coming again? I know a lot of business owners that I've talked to over the past several days are very concerned about that. With the fact that that could happen. And many are wondering if they can survive if we do that. I hope it doesn't come to that, but we'll wait and see. So that's where we are market-wise, pretty significant. Got to keep an eye on the bond market. We get a pause in that tomorrow. And then Thursday will likely be a lot of movement. There was a bond auction today on the 10-year, largest ever, by the way. That shows you how much debt we're managing right now. They had the largest auction ever. And Rick Santelli on CNBC, I usually watch his report at 1 o'clock because he gives the bid to cover and he grades the auctions, etc. Gives a lot of good information on what's going on in the bond market. He rated it a D-. And what that means is that it was not very heavily subscribed to. And that's another thing that, you know, helps to tick rates up, because if the demand isn't there for the bonds, then interest rates have to go up. They have to entice people to come in and buy them. So when there's not a lot of demand for the bonds in the auction, they raise rates to try to say, hey, you know, look how much you can get now. Now do you want these bonds? And because we have to finance all the programs, the debt, everything that we're doing has to be paid for. And so that's the way they're doing it. And they have to entice people to make those purchases. So the reading, if you had like an A reading on a bond auction, that would mean it was heavily subscribed to. There's a lot of demand. So if there's a lot of demand, then yields and rates go down. But when there's not a lot of demand, yields and rates have to go up to try to entice people to buy them. So that's how it works. So when you have a D on the report card, people aren't buying bonds. So where's the money going? Is it ready to go back into the equities market? And we'll find out. Again, hopefully we get a couple quiet days here. And then if you're long the market, and I love to trade the market to the downside. People ask, does the Elliott stuff and searches and all the things you do work to the downside? Yeah, we just have been, other than the move down in March from the COVID thing, have been mostly going up recently. But I love to trade the downside. You make money so much faster when you're trading downward moves. But you trade what the market's giving you. You can't hope things that go to the downside. But with that said, I understand that people with IRAs, 401ks, retirement plans, more people benefit when the market goes to the upside. So it's very counterintuitive or a difficult thing to kind of root for the market to go to the downside when you know more people benefit on an upward move. So we're in between this 61.8, so we've already reached that extension. Now the 100% is the only thing left, and it's not that far away from where the highs opened yesterday. All right, so I wanted to show you a couple of the alerts that had closed yesterday without spending a whole lot of time going through them. One of them was paychecks. That's you can see as trade ID number 212. And I wanted to share this one with you because it is a great example of one of the things that I believe in, which is making adjustments when things don't necessarily go your way in the beginning. So we already know that Elliott Wave has a very high percentage of accuracy. We have the empirical data. We know that, especially with the system that we utilize with the confirming indicators. So we know historically it has a high percentage of accuracy, but nothing is right 100% of the time, nor is Elliott Wave. Sometimes it goes the other way. But when you have one that violates the high percentage of accuracy, well, now the percentages are even more in your favor that the next pattern will follow the Elliott Wave rules. And if you have a viable pattern, why walk away from it? To me, that doesn't make any sense. So that's one of the reasons that I really like the adjustment process. So the original entry was back in May, and with the big drop that we had in March, we had a bounce, and then we had a price target to the downside. That was the pattern at the time. And with the market, everything seemed to get dragged back to the upside because the Federal Reserve came in with historically huge amounts of liquidity. So we moved back to the upside. So the adjustment was finally triggered to give us an opportunity to go to the long side. You can see we hit this target, but we were overbought, so you can't wait. Or you can't enter, you can't chase is the word I was looking for. You can't chase the overbought scenario. So we had the big breakout day, moved to a new high there, came back down. That gave us the signal that we'd been waiting for quite a while. And then that allowed us 5 days later to go ahead and close this position out. Helped with that big move in the market yesterday, but you can see this massive gap, and you know how I feel about those. They're going to get filled. And now we're way overbought with that big move to the upside. And so we went ahead and closed that alert out. So the original alert didn't work. So this position at one point in time was 100% loser. Now this sideways things meant that we were waiting for the upward pattern to qualify. So right, it was originally a downward pattern. That didn't work. So you don't just necessarily immediately flip the other way. You need to let the pattern set up to where our indicators all give us the signal. It's not just, okay, well, it didn't go down, it must be going up. Well, now you're guessing. So maybe it's getting ready to go to the upside, but you wait until the indicators give you the go ahead, and then look what happened. Boom, to the upside there, and you end up with 100% gain. And that's the reason that perfect example of why I like to go through the adjustment process, but not necessarily immediately after one pattern fails. You don't necessarily immediately jump to the next pattern. Watch it, keep an eye on it, wait for your indicators to give you the signal, and then move in. Now, we've also been talking about for quite a while the market moving to the upside in that zigzag pattern. So here was the SPY position that we did in the impulse strategy. So the entry was on October 14th, and you can see that we had that little zigzag that I've been talking about that became qualified. So once that became qualified, we put on a long position. Now, understanding that when you have the first level of qualification, there's different levels of Fibonacci support levels on the way down. But if you wait and hope that it's going to go lower to, say, the 61.8% level, well, what if it holds at 23.6 or 38.2 or 50? What if it holds at those levels? Then you miss out on the trade. So you gauge yourself without violating good risk protocol to take advantage of that and get into the position. And so we did end up having that flat form. So that initial zigzag that was qualified became disqualified. The flat formed, but all the while we still had that larger zigzag that I just went through with you with the C wave target. That has not been disqualified. That was still in play. So there was no reason, because the smaller zigzag became disqualified, there was no reason to exit. And so we stayed in, and that generated a nice gain, 45% gain in less than a month. And that was a period of time where the market was going against us. And again, showing that on the mark to market, fully transparent. We show everything, moved to the downside, and then the market moved and followed the pattern and generated a nice gain. So this one wasn't recovering a loss as far as a position that was closed out. The market went the other way for a bit, because what was a qualified zigzag became a confirmed and completed flat. Then you move to the upside. Now we would have made likely a different adjustment if that larger zigzag pattern hadn't have been in place as the backstop, if you will, the whole time. So at this point in time, there was two upward zigzag patterns that were both qualified at the same time. One becomes disqualified, but the larger one did not. So it was a really good day yesterday for us. There's a couple others that we closed out as well. So we had another 100% gainer. I just don't want to show all the big ones, and you think that we get that every single time. We take good steady gains. We manage and adjust our losses, and that's why we have the portfolio performance that we have, and that our equity curve grows at the way that it's grown. So coming off of the 17 in a row winners, had a 3% loser, and then we've had 9 consecutive closed winning trades since then. So and the odd thing about the one that would close a 3% loss, if you know, had a crystal ball and waited a couple of days, that one would have been profitable too, and then we've been on one heck of a historic run. So we're doing well in what's going on in the market. If you're not a subscriber and you're interested, love to have you. Interesting times in the market. I think if you've been watching the videos on YouTube, you see that we've been pretty spot on with our calls recently. All right, now let's take a look at our recent case study considerations. That's another way that you can follow along and see how our system works. And 2 weeks ago, we looked at NSP, and this one is frustrating. Did not send this one out to our subscribers. You can see it's been on a great run. Why not? Wait in there, because the ADX has been outside that positive directional indicator, and that doesn't usually happen like that. It's just apparently the strength of the move was so strong that normally the way the DMI works, if you haven't heard me talk about the DMI, the two directional indicators, which is the green and the red line, those are quite responsive to day-to-day movements in the market. They move quickly with the market. The ADX lags a bit. It usually doesn't follow as quickly. So you kind of take your cue from both of them. You watch the directional indicators for the shorter term basis, and you want the confirmation from the ADX on a bit of a longer term basis. But in this case, the ADX was very responsive. It was moving quickly, and it just never let that positive directional indicator get outside the ADX line, which is one of the rules that you look for with the DMI. And the DMI has been a really good confirming indicator for us, complements Elliott waves so well. And you look back, and it was on the search at the time. And when it came time to send out the alert, I was waiting for that positive directional indicator to make a big move above it, but the ADX went so vertical. And so the good news is it was a result on the alert or on a search. You saw it. It worked beautifully. If you followed it, you're super happy. I didn't send it out as an alert to the subscribers because of the reasons that I mentioned to you, but the system worked, and hopefully you did extremely well with it. And then last week, I remember going through and saying, well, I really wanted to do a triangle especially with the uncertainty of the election and everything else that was going on. And we had a few case study considerations to look at, but I was pretty adamant about let's do a triangle, and look how well this has worked. So here we had our descending triangle. This was sent out as an alert to our subscribers, and boom, boom, boom. And so even with the market pulling back today, CYRX continued to move back to the upside with another 3% gain today. So another nice move. It didn't really come back at all. It's made a really nice breakout. So the case study considerations from the past 2 weeks have been great. I hope you all are following them and enjoying those. But that worked out extremely well. Okay, now let's take a look and see if we can find something for this week. Again, for those of you that are new, this program is called ProfitSource. And if you have the program ProfitSource and you're an Elliott Wave Options subscriber, my searches are pre-programmed in here. So when you watch this TradeFinder, the webinars that we do, and I walk through this, you're basically seeing what I do on a daily basis as far as analyzing charts. So I don't pre-look at things, I don't preset things. We walk through it together. You hear the thought process, and just instead of thinking it, I say it, and we go through and talk about that. A couple things to note here that I find really interesting is no impulse results. Kind of interesting considering how vertical the market has moved. We've had a pretty significant move to the upside. Seems like there'd be something on the impulse side. So that's really interesting. We have two corrective charts to look at, so we're going to look at those. What does make a lot of sense is that there's only 12 in the consolidating stocks list, which is where we find the triangle patterns for our volatility strategy. With a pretty vertical, volatile move to the upside, makes sense that there's not a whole lot of stocks that are consolidating right now. A lot of them have broken out with that move. So that makes sense. The fact that there's zero impulse trades is a bit interesting. And the two corrective stocks, let's take a look at those. So we have JD, and this is pretty much anything China related. We also had an alert on FXI, which we closed out. We had one on Baidu, which we closed out. And then yesterday, there was some news that came out from a regulatory standpoint. I don't know the exact details on it, but I know China is cranking up their regulatory situation, which is kind of interesting to me. Of course, I don't understand how the China government runs things or what their thought processes are, but you would think that they would be looking to open things up a little bit more with a potential change in Washington to an administration that may be a little more China friendly than President Trump was, where he was holding them, on the carpet, if you will, and the trade tensions, etc. Well, with that potentially changing, you would think they would be loosening restrictions instead of tightening them. But there was some regulatory issues on JD, Alibaba, several of the China stocks. And so this one moved back to the downside. So that's why it's on the corrective list. Now, the issue here, as far as trying to do anything with this right now, is that we're on massive support. So as far as the wave 5 ending and moving back to the previous 4, you would need to see that level there at 80 broken first. So then the other, remember, corrective patterns can be either a completion of the wave 5 and a move back to the previous 4, or it can be, in this case, which is possible, a potential zigzag, which remember is a corrective pattern setting up in the wave 5. So then let's take a look and see where the correction is here. And it's basically at 70%, which is where Elliott said, when you see that, that becomes disqualified. Did a webinar last week where someone was saying, well, A lot of people talk about 78.6, and that is the fib level that officially disqualifies it. But Elliott, which I think bears a lot of consideration when it's the guy that created the system, says if you correct 70%, then it's likely disqualified, and just leave it alone at that point in time. So I don't know if there's much to do here at this point. If it was, it's a little bit of an expanding triangle. We don't do expanding triangles very often. They're pretty rare. And usually an expanding triangle is more of a symmetrical view, but it is an expanding ascending triangle. So you can look at it that way. The ADX is high, which violates the triangle rules. But at this point in time, what would make the most sense is some sort of a strangle, our typical type of a strangle pattern. And there's lots of liquidity in these options, and the spreads are nice and tight. So I mean, they have January and February options on it. They have both available. So that would be a consideration there. And it's an $80 stock that can move. We've traded this one in the past as well. Obviously, when we're doing a triangle, I prefer to have the ADX below 15. That's not going to happen when you've had a move like this, but that's a possibility. Let's take a look at the other one on the list, CALX Networks. CALX. Well, this one, the wave 5 is at 67%. We hit the wave 5 target twice. So it came up, found resistance, came back down. Looked like it was about to close that gap. Didn't quite get it closed. This gap right here I'm talking about. Didn't quite get it closed, but pretty close. Went up, retested that wave 5 target, and fell back down. So this one could be looking for a move back to the previous 4 at this point in time. You can see it held the 50-day moving average on its low. If you watch the moving averages and you see intraday highs and lows in the stocks, watch these bars like this, it's amazing how often they hit one of these major moving averages and move back the other way. At first blush, it's amazing, but then when you realize that there's a lot of program trading now, and what are they programming it? They're programming it off of Elliott wave patterns, moving averages, etc. Fibonacci, support resistance levels are a big part of program trading, etc. So we filled that gap. We touched the 50-day moving average. If you wanted something that was a touch more conservative, you would let it close below there. The more conservative is 2 closes below there. And then you have to wonder, well, if it closes below there twice, how much move is left down to the previous 4? But at this point in time, we're just a tiny bit oversold. So there's the low of the day and where we closed. The high actually did hit the 10-day moving average, but a little bit of separation, which you normally wouldn't think that's too much, except that we're dealing with a $23 stock. You might want to see that close up just a bit. But this stock's been a bit volatile going back to October 21st when it gapped to the upside. But it looks like it may want to make that march back to the previous 4, but wait for at least one close below the 50-day moving average. So those are the 2 primary ones. Let's take a look. I want to see if there's anything that has consolidated. So you can click both of these within a wave 4 buy. And look at that. There's our stock from last week. So it's telling us this one still has room to go. And so that was our triangle last week is the one. And I didn't look at that ahead of time. So don't roll your eyes. That was not preset. I had no idea that was going to show up. I just wanted to see if there was anything that is consolidating with a a potential move as a wave 4 buy, and that's what showed up. So pretty interesting there. So if you did follow that one last week and you haven't gotten out yet, possibility that that this continues higher, at least based on the Elliott wave 5 pattern. We're a little bit, the DMI hasn't gotten there yet, but it's thinking about it. You can see the ADX is trying to turn up. We had all this snaking here. That's what I call that pattern when the two directional indicators just weave in and out of each other. That happens a lot when the stock goes sideways. I call it snaking because it looks like the pattern a snake leaves in the sand. But we're starting to break above that, but you can clearly see, I'm sure I don't even have to draw this for you. You can clearly see where the resistance lies right up here, just underneath 60, breaking above that. And now we're really off to the races. So it may have a little bit of resistance there around 58 in that range. But if it breaks above there, then this target here in the wave 5 should be hit in a relatively short period of time. So with this, let's see what the volatility looks like on JD. Maybe just a bit too volatile, but the only thing that makes any sense really is to do one of our strangles on this. Yeah, it's pretty high. It's really high, actually, because of that news that came out on the regulatory things that China is doing. So if you're new to the world of the strangles that we do at Elliott Wave Options, volatility is a big important part of it. We trade well out of the money, looking for the best delta gamma relationship, which is the speed in which options will make money as the stock moves. And volatility is one of the components of out of the money options. So you want to be careful that you don't way overpay for the options with the fact that you could be right on direction or get a big directional move and not make money because they pull all that volatility out. So that becomes the question. We can deal with a little bit of elevated volatility because we're going so far out of the money. Implied volatility affects at the money options by far the most. It's not even close. At the money options are the most affected by implied volatility. So buying the options further out of the money, you get away from a little bit of that. You don't ever get away from all of it, but so you get away from it. What I was trying to say is that if you have a little elevated volatility, you can live with that because you're further out of the money, but this was really high. So with that, it's just, we don't want to mess with it. So that creates a challenge for a case study consideration for this week. Perhaps the best thing to do is do a continuation with CYRX, watch for it to break above this level, and then continue to trade it directionally. That really seems to be the best scenario. So this is a rare case where we're not finding a really good hard case study consideration with the result of our searches. There just wasn't a whole lot to look at. But think about this. So there's 2 corrective moves, there's 0 impulse, and there's only 12 that are consolidating. Out of the thousands and thousands of stocks that exist out there, we got it down to just a handful to look at. And that's one of the things that saves you a great deal of time when you're trying to identify trades, is instead of looking at chart after chart after chart, or watching stocks that are in the news, or dealing with the FANG stocks or the hot tech stocks at the time when the tech sector was hot, instead of doing all that, whittles it down to where you just have a handful to take a look at. All right, so got a few minutes left. I'll go ahead and take some questions with the remaining time. Is BABA oversold and ready to head north? Well, it's oversold. It's definitely oversold, and it's sitting on support. pretty good support right there. So it was resistance back in July. It became support in September. It broke off of it. BABA is interesting because this move down here, I mean, they blew away their earnings. They had massive earnings. But Jack Ma, that owns Alibaba, also owns a company called ANT, and Alibaba basically owns it. And they went through some regulatory stuff. And so that took a little bit of shine off of the earnings that Alibaba had. So it comes down, it consolidates that. Looks like we're ready to go back up, fill this gap, and take off. And then they get hit with more regulatory news from China, where the government is tightening restrictions on them. So how severe is that going to be? I tend to think that some of that stuff is noise. Watch the patterns. We're at a very important level that should hold here for a continued move back to the upside. We had the gap down today because of the news, and a little bit of a gap there that's basically been filled. So it should hold this area. Now the question was, is it oversold? Yes, it is. You can see the 10-day moving average is way up here. Stock is way down here. It's definitely oversold. As far as is it ready to turn and head back to the upside, it may need to catch itself a little bit. What would be ideal, honestly, is if it did one of these things here, where it kind of just went sideways for a bit. See, like right through here, if it went sideways for a bit right on top of this level, the support resistance level. So if it consolidated, then it would be set and ready to take off again to the upside. So because of the drop today was so severe and so vertical with the regulatory news, it wouldn't hurt it just to calm down a bit, relax, consolidate on top of support, and make another run, just as it was doing before the other stuff came out about it. Roku. So I assume this was earnings. I think that was the earnings day. Breakout, unfortunately, didn't close at a new high. So you see you have a butterfly on it. I'm not sure where your butterfly is, but we broke above it, didn't hold above it. Then yesterday, with yesterday's crazy day, it was already moving back because of it was overbought from Friday. And then here's a little bit of separation there from the 10-day moving average. So we came back and we solidified that, held in there pretty well today. Here's the key. It needs to stay and hold this level of 220. It's drifted below it. It could come down to this previous floor. It could actually correct a lot further. But with this move here and labeling the 5, then you can't relabel a 4. So unless the whole entire pattern relabeled, look at the DMI, see if that tells us anything. And it was overbought when all of this stuff happened because the ADX was way above 40. I think Roku just needs to settle for a bit. So I hope your butterfly is somewhere around where it is. If it is, then I think you're going to be in really good shape because it looks like it wants to consolidate this move for a bit. Well, the SPY target Pankaj is still the 381. Once that happens, now that we already have the vaccine news out of the way, that was one of the big catalysts. The two primary catalysts were how big is the stimulus package going to be from the government? And that was one of them. And then the second one was and expected to be a little further down the road than where we are now was the vaccine news. And so we had the vaccine news. Now we wait for stimulus package, and we see what the Federal Reserve does, whether they renege a little bit. I mean, they acted like at their last meeting that they were going to start another quantitative easing round. Will they? Boy, sure doesn't look like it yet based on what interest rates are doing. Looks like they may still be siphoning money out rather than injecting money. So I don't know if they're being really, I have made the comment, and hopefully you watched that the Federal Reserve can definitely influence equity markets, especially with all they did back when we had the big drop in March. But even the Federal Reserve, unless it's a coordinated effort with all central banks, is not large enough to control the bond market. They can influence it, but they can't control it. And the fact that rates are still rising leads you to believe that they've not embarked on quantitative easing. In fact, it makes you wonder, are they still withdrawing liquidity? So we're not going to get any answers on that until Thursday at the earliest, with the bond market closed tomorrow. But at this point in time, it does look like that 381 target is going to be hit. And then I think we have to really take a good hard look at things. I'll look at the Qs. The other ones we'll look at Thursday night. Pankaj, we'll look at those Thursday night. I'm cheating a little bit. So we'll look at the triple Qs. And chart is pretty similar to the market, except it did not make a new high. So it did not break above the recent wave 3. We got a lot of resistance here. We're sitting on top of all 3 major moving averages. We could be forming, and it's not ready yet, but the possibility of forming an ascending triangle is there. But it needs a few more weeks of work, really, before it's a decent pattern there. The Qs are just waiting to see if they're going to make another, make a run at new highs, but it didn't yesterday. Steve asked, any idea what percentage of people were negatively impacted by online broker outages on Monday morning? It was pretty interesting trading. Market makers were taking a few extra cents here and there as well because of the big move to the upside. And if you didn't hear, the reason Steve's making this comment is so much was going on. Some of the brokerages basically froze a bit from the activity. A lot of flurry of, I don't think anybody expected that announcement to come out early in the morning hours of Monday morning. I have no idea how many people were affected. I knew that there were some outages, and but I don't know the answer to the question as far as how many were affected. No, it's definitely not. It's a sick feeling when you can't access your account, isn't it? I mean, that's just, yeah, it's frustrating. I've had times when I was talking about how fast they're trying to fire out trades yesterday, when the market had it's been a few years now, but the market had some pretty volatile drops, and the same type of thing. Things are moving so fast to the downside, and you're just going as fast as you can to get trades done, and waiting on the fills, because everybody's getting, especially when you can imagine what happened on Monday. That was to the upside. So think about it when you have I don't know how long you've been trading, but when you have a huge volatile move to the downside and everybody's trying to get out, and you have panic, right, because of the downside move, and you're just trying to get, I like to get out and take the trades, but when people are getting out, they clog everything up. And so you want to get those prices while things are moving, because when it goes down so volatile, sometimes the snap back is pretty volatile too. 78.6 retracement is key, super key in currencies. Just haven't found it to be as important in equities, but it's super important in currencies. AZN. Well, there's an expanding triangle for you, but we don't have a lot of data. No, AstraZeneca's been around longer than that. I don't know what's up with that, but that's definitely an expanding triangle right there. So looking at the options on AstraZeneca, it's January has great liquidity. Didn't show up on our screen because the ADX is too high, but super liquid and out to January, and definitely an expanding triangle pattern. That actually looks pretty good. So good spot, right? Microsoft. And I hope Microsoft doesn't go back to doing what it did 10, 20 years ago when it just did nothing, move sideways. But we're definitely in a trading range here. So we got flats going on. Massive support at 200. So that's the key level. 200, 230. It's a pretty easy chart to read. So here's your flat. Yep, I didn't click the high enough, but there's the flat. And then it's trying to figure out what it wants to do here. So is it starting another one? It's Microsoft used to be the stock that I would use to illustrate flats years ago, because it didn't do anything. It just stayed in a trading range. And if you were a at the money butterfly person, Microsoft was your stock. It was perfect for it. It just stayed in a trading range, did flats all the time. Finally, it's, last few years it's been moving, but that looks like the Microsoft of old right there. But anyway, they answered your question. Resistance at 230, support at 200. In between there is a guess. Apple. That's a pretty nice triangle too. Look at that one. That looks pretty good. Yeah. Oh, the ADX is close, just not quite low enough. That's why it didn't show up, but it's close. Yeah, that looks pretty good too for triangles. So the better charts y'all are showing, they weren't quite low enough to make the search results, but AZN and Apple are both decent looking charts. Need that. Where's the VIX? It's back down to 25. That came down a little bit. A real quiet day tomorrow would be really nice for the market. Be really nice. Set up a lot of these trades too. Tesla. We talked about this last week, how it looked like a false breakout one way and then another, and it's forming a larger triangle. So it's still doing that. Now you can see it's a big triangle. So I'm interested as anybody else to see which way it moves. It's going to. It's just going to be interesting to see which way. I don't know how the new administration equates to that or whatever. I'm not sure. So AB. Lance Bernstein. Not super familiar with this one. It's not a bad looking triangle though, is it? Just doesn't feel like it's finished, like it wants to bounce off that upper trend line and come back down. Interesting how that was a continuation of the wave 3 there. Then the wave 4 pullback. Didn't quite make it to the 38% level. But you have a nice corrective triangle there in the wave 4. And that could very well spur the move back to the wave 5. All right, everybody. Thanks. Appreciate your time. Appreciate the questions, and hope you've had a great week. It's definitely been an interesting week in the markets. We've had a good week, and looking for quiet day or two in the market, and then resume things. Hopefully, to finish off that C wave target. So again, always appreciate your time. Thanks for watching. Have a great week, and I'll see you next week.